Hello and welcome to our quarterly market update. Today we'll be going through a look back on the final quarter of 2024 and a bit of a look forward to what 2025 has in store. I'm again joined by Hugo Good, who's joined me in Melbourne. So the main things that we'll be talking to are the Trump presidency, the impact on China or what's going on with China and the broader concerns for the economy there, as well as the broader outlook for markets in 2025. So Hugo, you did the heavy lifting on the economic report this time around. What were your main findings?
Yeah, firstly, thanks for having me down in Melbourne. It's great to be down here. Main findings, looking back at the quarter that was, it was really a down, then up, then a bit of a sell-off towards the end of the quarter. What was a dominant theme was US exceptionalism. Really, the Magnificent Seven, particularly in those final few weeks, rallied hard. And outside of the US, Europe, and our very own Australia, didn't fare quite as well. However, it was quite a good quarter in general for portfolios. And looking back at 2024, it was another really strong year with a risk-on environment, as it was in 2023. When we look back at what happened during the quarter, in October, there was a lot of policy uncertainty. People weren't sure exactly what the central banks were going to be doing, how much would they cut rates. As a result, we saw bond yields rise on the back of that. And we also had a lot of political uncertainty. So obviously we had the all-important US election that we were closing in on, and it wasn't certain who was going to be elected. However, when it became more clear that Trump was going to win and eventually getting the red sweep where he secured both houses of Congress, we did see markets rally quite strongly, where they focused on his pro-growth agenda. And it was very reminiscent of when he got into the office in 2016, and it was a short-term catalyst for markets. December, the sugar hit started to wane a little bit. Investors started to worry a little bit about some of his more inflationary policies. And then normally when we sit here at the start of a new year, we talk about the Santa Claus rally. However, it was quite absent this year, notably absent, where Jerome Powell, the US Federal Reserve Chair, he played the role of the Christmas Grinch, you could call it, where the FOMC members came out with their projections for rate cuts in 2025. And previously they had expected to cut rates 4 more times. However, now they've reduced it down to 2. So higher for longer seems to be the US Federal Reserve's view at the moment. It's
an interesting one. We've sort of been of the view of higher for longer for a good couple of years now. Obviously, with inflation being more sticky. I mean, what are your thoughts around higher for longer? How does that play out?
We have been of the opinion of higher for longer for quite some time. If we think back to January last year, in 2024, I think the market was expecting around 7 rate cuts over in the US and about 2 to 3 here in Australia. However, as we know, the US Federal Reserve only cut 100 basis points, and the RBA, as of December, kept rates on hold at 4.35%. So that was the 13th month in a row that it kept rates steady at that level. So it's good to get that one right. When we look ahead, I think in Australia, we have our own domestic inflationary pressures to deal with. And that's partly to do with the labour market tightness. It is a very tight market at the moment, and that feeds into wage prices. When there's not a lot of applicants for jobs, employers have to incentivise them through higher wages, and that feeds into overall inflation. So the RBA is worried that without a loosening in the labour market, inflation pressures will persist. Over in the US, I think GDP growth is really strong, and some of Trump's policy measures could be quite inflationary. So I think they're waiting to see what policies are announced and how 2025 unfolds before it cuts aggressively again. There is a good chance that potentially they keep rates on hold for the next couple of meetings just to see how things pan out.
And of course, in the current environment, it's very hard to do anything without considering the new president coming in. How do you think about the impact of Trump on the US economy as is, from inauguration on the 20th of Jan onwards?
Yeah, interesting. I'm not going to sit here and pretend like I know exactly what Trump's going to do. And I think anyone who tells you they do is kidding themselves a little bit. However, when you look at his big policy agendas, immigration, tariffs, tax cuts, deregulation, and I just guess a generally pro-business administration, what can he do on day one? It's really the immigration story where he can cut visas or restrict visas, as well as tariffs. He can increase tariffs from day one via executive orders. So those other policy measures that the market has been focusing on, those tax cuts and deregulation, which has helped fuel markets, will take a longer time to implement. So we think about immigration and we think about tariffs. That really hits the supply side of the equation, and it reduces supply. So if demand stays consistent and supply comes down, that generally leads to higher prices and could be inflationary, which again could give the US Federal Reserve pause for concern, before they embark again or continue cutting rates aggressively.
Absolutely. I mean, tariffs are a big question. Have you looked at the sort of impact of tariffs more directly?
I have, to a degree, but I might throw this one back to you. I know you've been doing a lot of work for the quarterly market update and a special article on the Chinese economy and the state, I guess, of the economy over there. What have you uncovered? Because those tariffs, if implemented in full, likely would hurt the Chinese economy, you would have thought.
Yeah, look, I mean, I think as we're getting closer and closer to Trump actually becoming the president again, rather than just president-elect, we are getting closer and closer to the detail. And, those people around him seem to be in unison talking about tariffs as a negotiating tool. So I think it's fair to think that they won't necessarily be implemented in full. And let's bear in mind, the Chinese economy and the control system within the Chinese government means that they are able to look over sort of long time horizons. They're not, stuck to a 4-year election cycle or what have you. So, we believe that that China is probably pretty well prepared for the tariffs. That doesn't mean they're protected, but they've had plenty of time to think about this, and so we're not sure that tariffs are necessarily as big as you would initially assume them to be. But then China's got bigger problems to deal with. We saw a couple of times last year, we're seeing China effectively get stuck in that middle income trap that the World Bank's spoken about over the last couple of decades. And, they've done very well to get to where they are, but there are some structural issues that are holding them back from moving to the next stage. Now, at the moment, one of the biggest issues, which is of course very crucial for any economy, is population growth. And looking at their population growth, it is in decline. And years of one-child policy, which has led to other issues, has now created a lack of young people. And that means that as the population gets older, there are less young people to pay taxes or to do those support sort of jobs that will support the older population. So that's one big issue. We think that with the reaction, that the fact that they're not stimulating more, they have been incrementally stimulating, but when you consider the likes of what we've done in the West with those sort of shock and awe type quantitative easing and fiscal stimulus type approaches, China has not been that aggressive yet. And I guess there's two ways of looking at that. There's two schools of thought currently. One is that they're biding their time and sort of sitting on dry powder and waiting for it to become clearer what the Trump administration will do so that they can respond more cogently. The other is that they are ideologically stuck. And it remains to be seen which. But we delve into it in the report. I encourage everyone to read that because there are a lot of intricacies, and I don't think we have time to go down all those rabbit holes right here and now. But putting it back to you, the world is facing, I guess, a little bit more uncertainty. We've sort of been facing it a bit the last few years. Of course, we had the pandemic and everything like that. But when you look forward and think about the higher for longer and how that might impact investors, those investors that are more income centric, what is the mindset for them?
Yeah, look, it's a great question. Higher yields generally translate to, I guess, higher income levels over the long term. And long-term bond yields are trading at elevated levels at the moment. And so for investors who can lock in that attractive yield, that'll be able to provide a stable source of income to their portfolio over the next couple of years. So we do think yields are at really attractive levels at the moment. We aren't going back to the near zero or close to zero interest rate policy that we had during COVID. So even if we do start to see some rate cuts towards the end of next year, or this year I should say, sorry, it is 2025 after all, yields will remain elevated, and we do think income will be strong for those investors looking for it. In addition, I guess they do have defensive qualities as well. particularly fixed income. So if we do face any economic headwinds, there are diversification benefits that they can provide to the portfolio.
Yeah, and of course for those income investors, that the fact that inflation is down, it's that sort of Goldilocks area where it's down enough that it's providing a real yield, an inflation adjusted positive yield, but not down low enough to bring interest rates down. So it might be a little bit of a sweet spot for income investors right now.
Yeah, exactly. It's interesting. You were talking about China and some of the woes they're dealing with. Something that comes to mind is the property market. The Chinese property market is down around 15-20% off its highs. Australia isn't facing anything like that, but we did see a decline of 0.1% in December, which is notable because it was the first decline that we've seen since January 2023, according to CoreLogic data. So when I look out to the Australian property market, which is very important for the Australian investors, given our love affair with Australian property. There are some cyclical short-term headwinds. Poor affordability comes to mind, which is high house prices relative to the average wage earner. They're at very elevated levels, could be, if not the highest, one of the highest across the globe. In addition, mortgage repayments are still elevated. There was a lot of house owners who were holding out for that interest rate cut towards the end of 2024, and it hasn't come. So we are seeing some consumers now, or homeowners, I should say, opting to sell, into this market. So we are seeing an increase in supply. However, there is, I guess, an undersupply of housing from not building enough houses over the last decade and a half, and strong immigration that should help support house prices in Australia over the medium to longer term. So I think also, and you've done a little bit of work on this, there are some families in the low income bracket versus high income brackets that are very much experiencing different economic realities at the moment. Do you want to discuss that a little bit?
Yeah, it's a really tricky environment because, if it's that old economic maxim of, having your head in the freezer and your feet in the oven, which is on average you're fine, but neither your head or feet are good. And you could argue that lower income families are suffering from that at the moment because on aggregate, the Australian economy is doing very, very well. But if you're a lower income family, or indeed if you're just younger, right? Basically the statistics we've seen is if you're below 60, you're struggling from just keeping up your spending with inflation. So you're either just matching inflation or you're actually spending less once you adjust in inflation terms. So that's a real issue that people are facing. And whilst inflation is coming down, that inflation is the rate of change. The level isn't going down. So basic goods are still very expensive for Australian consumers, and if you're not earning a lot and if you're not benefiting from those rising asset prices at the same time, and you haven't had any reductions in your mortgage rate, it is a tight environment. And the good news is that whilst unemployment stays as low as it does, you would hope that over time that those conditions improve. There is still wage price inflation, which is making it harder to bring down interest rates, as we've discussed, but it does also then feed the spending ability of those lower income families. So you would hope with that over time things will gradually improve. But there are a lot of distortions in the Australian economy and the US, in the global economy that probably need to be resolved. And yeah,
I think it's going to be a big hot topic issue for the upcoming election here in Australia, and as it has been in all the elections that we had last year.
Yeah, we're definitely going to hear more about it. Obviously, we could talk about this for hours. There's so many interesting things going on. Thank you for all your hard work on the report. And thank you for joining us. 2025 is sure to be an interesting year. We have the second Trump presidency, which is bound to have some degree of fireworks associated with it. How China reforms its economy and reacts to a new trade war is certainly going to be interesting. And of course, the path and level of interest rates will remain ever present in our considerations as investors. Thank you for joining us, and we look forward to seeing you again next time.